Good evening, everyone. Welcome to our Long Beach State Alumni Homebuyer Workshop. My name is Jason Maida. I'm going to be your host for this evening and presenter. It's great to get a chance to get connected with everyone. We have quite a few signups for tonight's class, so we're going to allow everybody to get into tonight's class, and then we'll go ahead and get started within about a minute or two. Just to let you know, this class is going to be a very interactive session, so we encourage questions as I roll through tonight's content. You can use the Q&A function within Zoom, and then I'll answer those questions on air for you. This class that we're teaching you tonight, we teach all throughout the country. Specifically for our Long Beach State partnership, we do it once every quarter. And if you like some of this content, we'd love for you to share that with your friends, family, maybe some coworkers. These classes that we provide across our local communities are free services that we help to kind of really just provide really more resources around home buying for you. So this is going to be hopefully a very fun class for you, but a lot of information that hopefully is going to help you on that journey towards home ownership. So we really want to help prepare you that whether you're trying to buy maybe this year in 2024 as a goal, or maybe it's 2 or 3 years down the road, you'll have all the tools and resources that you need to help you along that journey. A little bit about me. So I work for a company called American Pacific Mortgage. We're a nationwide lender. In fact, we're a top 10 lender in the country. My offices are based out of California. I service all of California as well as multiple states right from our office here. And our primary focus is on homebuyer education, specifically for first-time homebuyers. So a lot of what you're going to learn tonight are kind of like building block items to help you in that journey towards homeownership. And I work with a state agency called CalHFA, which is the California Housing Finance Agency. It's designed to support low to moderate income buyers. You're going to learn a little bit more about some of the products that are offered to first-time buyers through HFA here in California. So we will spend some time tonight looking at a little bit at down payment assistance programs that might be applicable for you, but we'll also take a look at some of the other products that are offered to you as buyers in today's market. So tonight's talking points are going to look like this. So we're going to spend some time in just a minute doing a quick rent versus buying analysis. We're going to talk a little bit about if I had to continue to rent and stay on this path, what does it look like? But if I decide to buy, what could that alternative option look like for me? We also want to look at the housing market for a bit. We're also going to spend some time looking at interest rates and how those are impacting buying power for some of our future home buyers. And then from there, we're going to transition into looking at credit and, how do we get our credit in the best possible position for home buying? Also spend some time talking about student loans that are in repayment right now, how that could, impact your qualifying. And then we'll move over to various loan programs. We'll talk about documentation that we need to start to gather if we're thinking about being pre-approved for a home purchase. Again, we'll talk about assistance programs. And then the last two topics will be more around the more workflow of buying a house. So after tonight's class, if you say, hey, you know what? I really want to put together a home buying plan and figure out how I too can get on the path towards home ownership, we're going to walk you through the milestones to be able to achieve that goal. All right. So that's kind of what tonight's class is going to look like. Hopefully you enjoy the content. And I really encourage you to ask any questions that you have as we roll through tonight's material. So let's first kind of kick off tonight's class by kind of looking a little closer at buying. And does buying really make sense to me or make sense for me as a future first-time home buyer? So when we think about the benefits of a home, we really can't do a accurate side-by-side comparison to renting, because there's a lot of great things that come out of owning a home. Like, for example, as the home appreciates in value, equity is created, right? So the difference in what I owe on my house versus what the market value is, that difference creates equity, that creates wealth for me over time. I can now, as a homeowner, control my affordability or my monthly budget, because now I'm at a fixed monthly payment and I'm not worrying about maybe my mortgage company increasing my payment, because more than likely I have a 30-year fixed mortgage. Whereas a rent, I'm obviously subject to what the landlord decides to increase my rent to every time I renew a lease, right? And believe it or not, there's still some really good tax benefits that come along with owning a home, where potential interest deductions can exist. You'd, of course, want to talk to a tax advisor, but there's still some really great options that can come along on the tax side of owning a home. So as we dive into tonight's class, I want to first start with a rent versus buying calculator. And we're going to switch screens in just a second. I'm going to take you through this rent versus buying calculator and kind of do just a what if scenario for you to help you better understand what that comparison looks like of renting versus owning a home. And I had a question that in the question in the question was, can I repeat what I just said one more time? So actually ask me what that topic was, and I will repeat whatever you didn't catch. But ultimately, kind of what we're going to do is dive into the rent versus buying calculator. Before I forget to mention to our audience, everything that I share with you this evening is going to be sent back out to you tomorrow in the form of our PowerPoint presentation. And if you missed what I just shared with the audience, everything is recorded tonight. So this class will be up on our YouTube channel tomorrow morning as well too. All right, so let's talk a little bit about this rent versus buying calculator. So we've kind of just put a what if example in here, and we're going to first start with a rent scenario. I do realize our class is from different parts of the state or maybe even different parts of the country. So cost of living is going to vary in those particular areas, right? But let's say we have an assumption that we're paying $3,000 a month in rent. We have renter's insurance of $15 a month. And then we're going to make the assumption that our rent will increase 5% every year we decide to renew that lease, okay? And then from a home purchase perspective, we're assuming that we're going to buy a $750,000 house. That the minimum down payment that we're going to apply to our home purchase is 3%. And then the estimated property taxes on an annual basis are $8,000. We have estimated homeowners insurance and then the maintenance cost of buying my house. So these are all data points that we're putting into our what if scenario for purchasing. And I would encourage you, by the way, to try to this own exercise for you at home at some point when you have a free moment, because I think it's a really helpful tool. From a loan information perspective, we have a 30-year fixed mortgage. We have average interest rate, maybe a little bit on the low side. Let's say maybe closer to 6.875. You know, rates have actually ticked up a little bit lately. So we'll talk about that in just a minute. We have origination charges. What origination charges are, those are the cost of obtaining financing. And one of the great things about our partnership with Long Beach State Alumni and Athletics is that you get a discount in our services. So we actually discount our services by $750 for your home purchase, okay? Or even a refinance if you're an existing homeowner. There's discount points that we have factored in. Now we put it as 0 here because I don't really recommend discount points right now. It's not a kind of a make sense type of thing, but let me explain to you what discount points are. Discount points are where you as a consumer can pay additional costs out of pocket to bring down your interest rate. Generally, 1% of your loan amount will help bring down the interest rate about 0.25%. But why I'm not a huge fan about it right now is because it usually takes about 2 to 3 years to break even on those type of investments right now. Question in the chat as it relates to property taxes. So the question was, does the yearly property tax get paid in a lump sum at the end of the year or monthly with the mortgage payment? So really good question. So property taxes are due to the assessor's office twice a year. So they usually do in November. They're also due in April. Now, as part of your financing as a first-time home buyer, you're more often than not going to have an escrow impound account, which collects your property taxes as well as your homeowner's insurance on a monthly basis. That money gets built up into this escrow balance. And then as taxes come due in November and April, we pay those from your escrow impound account. So, but from a budgeting perspective in this exercise, I just kind of gave you the total annual tax, but it is split up into 2 payments. We have other settlement services. Those are going to be things under the umbrella of closing costs. So when you think about buying a house, we need to save up for down payment. We also need to save up for closing costs. Closing costs can be as much as 2 to 3% of our overall purchase price, including lender costs and county charges, title, escrow, recording costs, all of that stuff. And then the last kind of section we want to look at is the other assumptions, which we're going to assume our home will appreciate hopefully 4% on an annual level. That will be in the house for 7 years. So why that timetable is important, because we're going to compare renting for 7 years versus owning for 7 years. We have the selling costs of our home, state and federal tax rate, and then finally the comparison of a savings rate. So what our analysis tells us here is that if we decide to purchase, our monthly budget is going to go up, right? Because right now we're paying $3,000 a month in rent, but owning is almost double. It is double. It's $6,400 a month. However, from a total cost opportunity over the span of 7 years, I have about $47,000 in opportunity when I compare renting versus owning. and obviously the positive goes towards buying. Now everybody's situation is a little bit different, right? So if you're renting a room for $500 a month and you want to go buy a $700,000 house, well, that math is probably not going to work. But for a relatively, comparable rent to own situation, that would obviously favor on the buy side. So I would encourage our guests tonight, check that calculator out. We'll get you all the material tomorrow so you can do that analysis on your own. But a great way to kind of launch into thinking more about home buying. Now, the other factor in home buying that's really important to think about is like, where's the housing market, right? And this spring and summer buying, which we're right in the middle of right now, will be quite interesting. In the past year, we've seen inventories levels kind of stall out. So why we got to that point is because a lot of sellers just don't really want to sell right now, right? A lot of sellers in Southern California or Northern California markets, or nationwide for that matter, really don't want to get off of those 2.5% and 3% rate loans they have right now and switch into a 7% mortgage. It just doesn't make sense from an affordability perspective. So that created a little bit of a logjam from an inventory perspective. However, as things start to change a little bit in the market, we're expecting inventory levels to increase about 10% year over year. This kind of snapshot that we're looking at right here gives us a kind of a look at the market. And so you can see home appreciation over the last 12 months. We have this kind of a nice little flat line here, but we've seen a little bit of a dip here. Some of this is cyclical right now. We're seeing a little bit of a 3% drop in prices. But this is kind of a wider snapshot. I think we took this one as kind of more of a nationwide look at things. Now, what's interesting is that when we look at how long things are staying on the market is definitely stretching out. You can look at the median days on market is like 37 days, which has changed quite a bit. So we're seeing homes stay in the market a little bit longer. And we'll see that number start to switch up a little bit because this data is through March, but we're almost in May right now. So we'll see more homes come on the market. The question that's really going to drive our activity levels in the market is really going to be what happens with interest rates. So, when I taught this class 3 weeks ago, we were talking to our guests about, hey, rates are probably going to start to come down as we move into the middle of the year. We expected that the Federal Reserve was going to cut interest rates in June. Unfortunately, we had some unfavorable inflationary data that came in. A lot of it's lagging data, but nonetheless, it kind of shocked the markets a little bit. And now, you're starting to see interest rates start to inch back up. So when I taught this same class 3 weeks ago, rates were probably in the 6.5 to 6.6 range, but now we've inched to the 7% level because of some of those inflationary reports coming in. But things are not all bad because when we look at, the European markets, they're starting to see inflation come down. They're probably on their way to cutting rates. And, we may be taking a little bit more of a conservative approach with our economic markets here. A lot of the data that's coming in right now is kind of early Q1 stuff. So, my hope is that we'll still see interest rates start to dip down as we get into the latter part of this year. But really why we're here is because of what's going on with inflation. And, all of us feel it in our daily cost of living, our housing prices. And that's, because, things are just more expensive, right? So, the Federal Reserve has lifted interest rates to try to combat inflation and balance out the economy, but the trade-off for that is borrowing costs are so much higher. And we witnessed that in October where rates skyrocketed to almost 8% or at 8%. Interest rates they've come down a long ways from there, but this kind of choppy road that we're on right now is probably going to exist for at least a couple more months until we get some definitive direction on what this market is doing. But the Federal Reserve wants to see inflation at 2% in order for them to start cutting interest rates, and so we're still well above that. So it'll be interesting to see where this market goes. But ultimately, interest rates are going to play a big role in our buying power for us as home buyers, right? But interest rates are not the same for everyone and every situation because interest rates have different parameters. There's credit eligibility. So the higher my credit score is, the potentially lower my rate could be. The type of product I select, a conventional loan versus an FHA loan could change the interest rate. How much I decide to finance is going to have an impact on my interest rate, my down payment. We talked earlier about discount points. So if I decide to buy down my interest rate with out-of-pocket expenses, that's a way of kind of bringing down that interest rate. Also, the term of my loan can influence my interest rate. So if I take a shorter term of loan, so let's say the standard loan is a 30-year fixed loan, but I feel really comfortable with a 15-year loan. I can do that. And for the most part, that's going to bring my interest rate down probably by up to much as a 0.5% in a lower interest rate option. But as we meet with our clients designing different home buying options, we're going to kind of tailor a plan that works best for you based upon, where you're at from a credit perspective, the product you're looking at, if you're looking at assistance programs, how much you want to finance, all those ingredients will help make up kind of the interest rate offering. But it's important to understand interest rates change daily for buyers. In fact, they can change by the minute. So, we may talk to a client in January with a certain interest rate, but then in June, it looks completely different. And that's because of the ebbs and flows of the economic markets. Now, credit plays a big role in product selection as well as interest rates. And so when we go through classes like this, we always like to help educate our guests on, how can you help improve your credit or maybe continue to do what you're already doing. Let's first take a look at the FICO score calculation for mortgage. And I think it's important to know that there are multiple scorecards when it comes to credit scores. So there's a credit card scorecard, there's auto financing, and then there's also mortgage. And so I can't tell you how many clients I meet with throughout the day that say, hey, Jason, Credit Karma says I'm at 720, but then we pull their mortgage score and they're 680 and they just get a little confused. They're not understanding why that is the case. And the difference is because there's different scorecards. So different risk factors that mortgage is looking at versus say the credit card score. And the credit card score is what all your monitoring services are going to use. All right. So this is the weighting of the FICO score calculation. So 15% is going to be how long have I had credit? So the more mature my credit file is, the higher my score could be. 20% is going to be how much new credit am I trying to access? Meaning, have I opened a lot of accounts recently? More importantly, it's going to be inquiries of credit, specifically hard inquiries. So if you're having somebody run your credit multiple times, those could create decreases in your credit score. There are rules in place for hard inquiries on mortgage and auto financing, whereas if you have an inquiry on day one today, you have 30 days of time to apply with as many lenders as you want, and it's the equivalent of one credit inquiry hit to your score. Now, one of the things we do a little differently for our clients here is we always start with a soft credit check. And the reason why I do that is because I don't want our clients impacted by us putting together an analysis for them on home buying. So we always start with a soft credit score, which does not impact your scores at all. 30% is going to be how much revolving credit do I owe? Basically, it's utilization of credit. So if I was to look at my credit cards and let's say my limits are $10,000, my balances are $5,000, I'm at 50% utilization. Now, our goal needs to be at least 10% utilization. Well, I should say below 50% utilization at the minimum. Optimal is going to be below 10% utilization. So if we've kind of stacked up some credit cards and we're at 80 or 90% utilization, we really want to do our best to get below 50% utilization. Let me give you a quick tip on how to best manage utilization, especially as you're preparing to purchase your home. So if you were to take some time tonight and pull out one of your credit card statements, right? There's two key dates on that statement. One is your billing cycle or statement date. The second date is your due date. If you can change your behaviors of paying off or paying down your credit cards, not just on your due date, but pay them off on your statement or before your statement or cycle date, here's the difference what's going to do to your credit score. So by paying off before the cycle date, you're actually allowing the credit card issuer is going to send out the information at the end of that statement date to the credit card, to the credit reporting agency. So if I can pay down that balance off or down before the cycle date ends, I'm going to basically be able to lift my credit score higher because now my balances report lower. I have better utilization and then, of course, a better credit score. Okay, so if you can change the behavior instead of paying on your due date and paying before and instead paying before your statement date, that'll help you improve your credit score immensely. And then the last component is payment history. And that's basically how I'm paying my bills, right? So if there's any lates that I've had, those late payments are rated as 30-day lates, 60-day lates, and 90-day delinquencies. So you really obviously want to avoid that. If I've had any lates, especially in the last 12 to 24 months, those are going to be the most impactful to my credit score. Now, major events like bankruptcy, short sales, collections, those are going to have bigger impact on your credit report. I'll show you a matrix in just a second about how long those will stay on your credit report. You want to avoid, if possible, closing out accounts and specific to revolving accounts. And so what we're talking about there is if you've had an account for, let's say, 10 years, right? Let's say it was an American Express account. You close it out. When you close out that account, it does two things. It basically takes away all that history from the reporting for the last 10 years, so you could impact your length of credit, but it also takes out a line of credit in the aggregate totals for your credit utilization. So you have kind of a double hit to your score. So you want to be very careful before you do that, because it could, hurt your credit score. In lending, we look at all three agency reports. So there's three agencies, right? TransUnion, Equifax, and Experian. We take the middle score of all three scores. So let me give you an example. So if I have my high score at 760, my middle score is at 740, my lowest score is at 720. From a financing perspective, I'm going to use the 740 score from a qualifying standpoint. Now, if I apply with my partner now is at 740, 720, and 700. My partner's middle score is 720, which is lower than my 740 score. So if we're applying jointly, we always have to use the lowest middle score between both borrowers. And that's really important to understand, because when we look at credit, it's not only going to impact our our interest rate offering, but there's things like mortgage insurance, which you're going to learn a little bit more and later on, the type of product that I have to offer for you, maybe a little bit more flexibility from a expense perspective. So those are things we really want to keep in mind when it comes to the credit side of things. Now, these are some of the maybe negative events or challenges that might have been on your credit report as kind of lingering items. This is how long they'll report on the agency reports. The event in the most recent 12 to 24 months is going to be the most impactful. So here's what I mean by that. Let's say I had a late payment, and that was in October of 23. Well, because that's within 12 months, I probably have a really big hit to my score. But as that seasons out over 2 years, you'll start to see your score kind of organically go up if you had that recently. Okay. So question in the chat was, what is the best way to close a credit card account? I mean, there's no really workaround to, closing, other than just you have to call your credit card issuer and say, hey, I'm no longer using that account. I'd prefer to have that closed out. They might want, you to email them that request, and then they would close that out. But again, you just want to be careful when you decide to close out that account, because ultimately what that's going to do is take away that extra credit limit out of your aggregate totals. All right. Any other questions on credit? Because I'm going to talk a little bit about student loans next. Any other scenarios that you guys want to ask of me on this? Okay. All right. All right. Again, if you have any questions, just go ahead and drop them in there, and I'll make sure we answer those on air. Let's talk a little bit about student loans. I know student loans, especially on the federal side, are in repayment. As we apply for a mortgage, it's important to understand that even though some of those student loans may not be in active repayment because of forbearance or deferment, I still have to count a minimum payment for qualifying purposes. So let me give you an example. So if I'm in, let's say, an income-based repayment scenario, and I have $75,000 in debt, but my payment's $250, that is the payment that we can use from a qualifying perspective. But let's say I'm back in school, I'm doing some grad studies, and I'm now in deferment, right? Because I'm active in school. If I'm still trying to apply for a mortgage, I do have to, as a lender, count a minimum payment against you on those student loans for qualifying purposes. And the way that works is that on a conventional loan, we take 1% of the aggregate balances, which, that would be a $750 payment. Or on a FHA loan, it would be 0.5% of those balances, which, would be a $375 payment. So that's kind of how we look at it from a student loan perspective. Most clients are going to be in active income-based repayment amounts. And so it's not, too big of a challenge, but, at times we do have to kind of cross that bridge of, trying to figure out ways to try to lower that student loan debt for qualifying purposes. And the 0.5 or the 1% calculation can be a little bit difficult for our clients. So the rule is basically, if you're in forbearance, you're in deferment, we have to use one of those different methods from a payment perspective. Question back to credit here that came in. I just want to answer for the group. The question is, how many credit cards or credit accounts should one have? So that kind of varies for everyone. I mean, I don't really have like a recommended number. I think if you get too many credit cards, it's a little too hard to keep track of. me personally, I have two credit cards, right? I use an American Express that I use, and I have a Visa that I use just because not everybody takes American Express. And that seems to work pretty well for me. But, everybody has their own kind of approach to that. I think you just got to be careful that you don't get in the trap of like signing up for credit cards just because they have these cool benefits or, they're doing this balance transfer promotion, that kind of thing. I think if you have 2 or 3 credit cards, I think that's more than sufficient. Because at the end of the day, some of that stuff gets tough to track after a while. So, but I think ultimately that's going to be up to the consumer or the buyer. So. And then the question was, is it smarter to pay off your student loan in full prior to starting the home buying process? Not necessarily. I mean, it depends on, where you're at in terms of your liquidity and how much cash you have on hand. I mean, I wouldn't want you to take away from your down payment resources to pay off student loan debt, especially if the student loans are at minimal payments because they have a longer term. So I would say that that would be a conversation to have during a consultation with us just to see what the right strategy is there. Because, if you have $50,000 in student loan debt and you use $50,000 to pay that off, well, that would have been really useful for a house payment because you'll probably get more mileage out of investing that in a house versus paying towards student loan debt, unless the student loan debt's at like an astronomical rate. But I would say we would kind of want to talk through that one-on-one a little bit. Let's talk a little bit about loan programs. And as you learned earlier in the credit section, every loan program has a minimum credit score requirement. There's also minimum down payment amounts for each loan program. So let's kind of dive into each one of those. You've probably heard about conventional loans. When we think about conventional loans, those are Fannie Mae, Freddie Mac loans. Minimum down payment of 3%, up to a loan amount of 765,550. That's called the conforming loan limit. Now, in high cost of living areas for most of California, we can go beyond the conforming limit. So if you're in LA or Orange County, for example, we can go up to a loan amount of 1.149825 million. Okay. That's called the high balance limit. Now, when we go over the conforming limit, the minimum down payment jumps from 3% to 5%. Okay. And that's because we're in the high balance space. If depending on where you're at in California, like if you're in the Sacramento area, that high balance loan amount doesn't go up to 1149. It's like 780, I believe, somewhere in that area. So, but that's the conventional product. It does have a minimum credit score of 620. Anytime we put less than 20% down on a conventional loan, we're going to have mortgage insurance. We're going to talk about PMI or private mortgage insurance in just a bit, and we'll do some comparison with the next product, which is FHA loans. And FHA loans have a minimum credit score of 580. FHA is going to be a much more lenient product as opposed to conventional loans. They do have a minimum down payment of 3.5% from the conforming limit amount all the way up to the high balance limit in your respective county. With FHA loans, there's a kind of a misconception that FHA loans are just for first-time buyers, which is not the case. You can be a second or third-time buyer and still utilize the product. This is a federally insured program. So FHA stands for the Federal Housing Administration. So it is government-backed. And we're going to learn about mortgage insurance for an FHA loan in just a bit. But when you think about FHA loans as compared to the conventional loan, a little bit more flexible from an underwriting credit score perspective. And then on the VA loan product, those are for our veterans that have served and have VA loan eligibility. That has a 0 down payment option. And with VA loans, you can actually go up to a variety of different loan amounts and still maintain the 0 down payment option. Some of our VA veterans that are using the product can go up to $1 million plus in loan amount and still have that 0 down payment option. VA loans will also complement with state assistance programs as well. So you're going to learn about CalHFA first-time buyer programs in just a bit. VA will also be compatible with that. And then the last two products are USDA and the jumbo loan product. The USDA loan is for clients that choose to purchase in more rural areas. That is a USDA, the Department of Agricultural insured loan. So to promote kind of growth in rural areas, up to a maximum loan amount of 1.1 million. USDA is 0% down option, but there's some different factors like guarantee fees that you pay within USDA loans, also compatible with first-time buyer programs as well too. And then finally, jumbo loans. Jumbo loans are going to be for clients that need to finance more than the conforming loan limits or high balance loan limits. Jumbo loans are a little bit different because now the down payment amount elevates quite a bit. So it's usually 10 to 15% down payment. Right now in today's market, jumbo rates can be a little bit higher than, say, the conventional product. It does have also higher credit score requirements, usually a minimum score of 680. There's also some additional asset requirements with jumbo loans. You have to at least have your down payment and your closing costs saved, but we also need to save money for what we call as reserves when we have a jumbo loan. And usually reserves are the equivalent of 12 months of your monthly payment. And so if I have an $8,000 jumbo loan payment times 12, that means I need $96,000 in additional assets that I have left behind after I've contributed both my down payment as well as my closing costs. With PMI, I want to do a quick kind of side-by-side comparison for you to not only explain PMI, but show you the differences between both the conventional and the FHA product. But let me tell you what PMI is first, so you kind of understand it. PMI stands for private mortgage insurance. There's private mortgage insurance on the conventional side, but then there's federal insured loans, which are on the FHA side, right? Because they're different types of products. Conventional loans require PMI when we put less than 20% down, but there's different ways that you can pay PMI on a conventional loan. You can pay it monthly in your monthly payment, of course. You can split the MI up between your monthly and your upfront costs. There's single premium where you basically buy out the mortgage insurance for the duration. And there's also lender paid mortgage insurance where you take a higher interest rate in order to buy out the mortgage insurance. 99.9% of our clients are going to use the monthly MI option. And the reason for that is because that has a cancellation option that states that when I have 2 years in my home or my original loan and 22% equity, I can apply to have my mortgage insurance canceled. So, and hopefully in an appreciating market and, rates changing at some point, it makes more sense generally to do the monthly MI option. Now, PMI is not the same for all buyers. It looks a little bit different. There's a variation of premium based upon credit score, how much you finance, and then what your down payment is. So if some of you in tonight's class have already got on maybe Redfin or Zillow and been doing some payment calculations there, be mindful that their calculators don't calibrate to like what an actual PMI amount is. I hear a lot of clients that say, hey, Jason, I did my calculation on Zillow and PMI is $400 a month, but then we get through a calculation together during a consultation, it's like $150. So just kind of keep that in mind. Our calculator that you're going to learn about later on is a really great tool to use to help kind of go through different payment scenarios for you. Speaking of scenarios on a conventional loan, if we looked at a $700,000 loan amount, for example, and let's say you had a 740 credit score and you put 3% down, you're probably looking at PMI of about $209 a month. Okay, so the more I can push my credit score up to that 800 level, that lower that mortgage insurance is going to be. The more I can put down, that's also going to bring down my mortgage insurance. Now, FHA, government insured mortgage insurance, works differently because there's two forms of mortgage insurance for FHA loans. There's what we call as upfront mortgage insurance, which is 1.75% of my loan amount. There's also monthly mortgage insurance, which is 0.55% of my loan amount. So the 1.75 gets added onto my loan amount, and then I pay the monthly premium based upon the total amount. Now, on FHA mortgage insurance, it cannot be canceled unless you refinance over to a conventional product. So you're gonna have to keep it for the duration of the loan. If we look at the same scenario with the $700,000 amount finance on the FHA side of it, we have to add in that upfront mortgage insurance, which in this scenario is $12,250. So that gets stacked on top of my loan amount. So now I'm financing $712,250, and then my monthly premium is about $320 a month. Okay, so it's going to be a little bit more expensive on the FHA side. What I coach buyers through as we design options for them is kind of figuring out what product makes the most sense, right? Because not everybody qualifies in the conventional product. And I think that's important to understand because not only the conventional credit score requirements a little bit higher, but especially in the last 12 to 24 months, conventional loans are going to look at your accounts open, your late payments if you have any inquiries, things that may exclude us from conventional may have us go the FHA route. FHA is still a wonderful product, even though it might be a little bit more expensive on the upfront because it allows more flexibility for our buyers to access home ownership. And the reality is the FHA loan probably won't be the long-term solution, but allows our buyers to get access really, right? So let's talk a little bit about the income side of things. So when we think about qualifying for a mortgage, there's documentation that we need to get together. And we provided a checklist of kind of items here on this screen here. So generally when we're putting together our information for us to review in your consultation, we're going to need you to have your last 2 years of W-2s, last 2 years of taxes, last 30 days of pay stubs, some of your asset statements for the last 60 days. That's all generally what we'll need from a documentation perspective. Now, if you're a self-employed client, we will need the last 2 years of taxes for you to determine your income for eligibility. One of the things I like to talk about in class when we get to this section is around employment, because there's a lot of like misconceptions around employment and, if I'm eligible to apply for a loan. In fact, I got one of these questions earlier today. And that is, do I have some of the things I hear is that I have to have 2 years on my job to be able to qualify for a mortgage, which just isn't the case. The way the rule is for underwriting in mortgage financing is I have to be able to establish a 2-year history. And that history can include employment and or my education. So especially for our alumni groups that I get a chance to teach a class to, we can take into consideration maybe undergrad work that we did at Long Beach State in my new job. Let's say I've been on that job for 2 months, and that's an accounting position, but I went to Long Beach State and got a 4-year accounting degree. In that case, I would meet the 2-year requirements for eligibility for financing. So it's not necessarily 2 years on the job, it's a span of 2-year employment and or educational history. Now, where it gets a little bit trickier is that if I have dual employment, and sometimes we see this in industries like the healthcare industry, where I work for multiple facilities, right? In that case, I do have to show I've been on my job for 2 years, or both jobs, I should say, for 2 years in order to use that qualifying income. Another kind of scenario to think about is if you're on a part-time working status. Part-time workers, we have variable hours generally. So in that case, we would have to show that we've been on that part-time job for at least 2 years. Self-employed individuals have to have their business active for at least 2 years and have 2 consecutive years of tax filings in order to be eligible for financing. There's generally a lot more documentation on the self-employment side, not insurmountable, but we certainly have to get certain documents together. If you have a full-time job, and let's say you're looking at, or you happen to be working for Uber or, you have some side employment, right? If you can show that you've both been doing your side employment for 2 years as well as your full-time work, then both streams of income can be used for qualifying. Now, one of the other questions I get a lot in working with clients is about supplemental income sources, right? So let's say I'm qualifying for a mortgage and I have my $100,000 a year job, right? But then I have some income I get from a roommate for $500 a month. Can I count the $500 to my qualifying? Well, some products will allow you to count rental income and future rental income for qualifying. Most products do not, especially first-time buyer programs. So just something to kind of be mindful of. Now, if you have a partner that's contributing to the household expenses or has additional income, let's say it's $5,000 a month or $20,000, whatever the number is, right? You can't count that income to qualifying unless that person is being added as an applicant in the transaction. Okay. So those are some of the scenarios we kind of encounter in working with clients. So I thought it'd be kind of helpful to share that with our audience in today's class. Now, sticking with the theme of income, I want to kind of share with you a kind of a calculation that we use in qualifying for financing. It's called debt to income ratio. It takes into consideration debts like personal loans, credit cards, car payments, maybe your personal line of credit, as well as the new mortgage amount. And then we look at that versus the gross or pre-tax income you have as an applicant. Usually we don't want those expenses to exceed more than 43 to 45% of that pre-tax number. So it's a really simple calculation. It looks like this. So you have your principal and interest of your mortgage, the property taxes for your new house, the homeowner's insurance for your house, as well as private mortgage insurance if we put less than 20% down. And if I'm buying a condo, maybe a townhouse, there's going to be HOA expense. So in this buyer scenario, let's say it's $2,500 a month in total household expenses, or sorry, housing expenses. And then let's say I have $500 in other expenses. That means I have $3,000 in expenses. And if my income is $8,500 a month, then I have a debt to income ratio around 35%. Okay. Now, as a lender, we can go up to 43, 45, even 50% at times. But keep in mind, we're using a gross monthly figure. So, we want to be careful we don't go too high on that debt to income ratio level. It's something that we're going to talk about during a consultation with you when we're designing a home buying plan for you, because we want to talk more about affordability, because there's two big goals in homeownership we have for you is affordability, and then we want that to be sustainable over time, right? So that's why it's this metric of debt to income ratio is more of a qualifying metric. It's not necessarily indicating affordability. So that's something we're going to talk about as we meet with you for your consultation. Question in the chat was, is gross income before taxes? Yes, it's before taxes. So it's all your pre-tax stuff before, things are pulled out of your monthly income, like your taxes like FICA, insurance, any contributions you're making, all that stuff. So it's all pre-tax numbers. So we're not taking home our gross figure, right? So that's why the net is what we're gonna have to budget off of, and that's where that affordability conversation comes into play. So the last component to building kind of a plan and deciding on home ownership is really about savings or assets for down payment and closing costs. Now, there's documentation required in that, which I shared with you a little bit earlier, checking in savings accounts. We usually need the last 60 days of statements from those accounts. You can potentially use 401ks, 403bs, and IRAs, but I always encourage our class to check with a tax or financial advisor to make sure you're not creating an issue for yourself long-term tax-wise, or eliminating an asset that is working for you right now in today's market. You can also have family members that are gifting funds to you. Those assets from family do not need to be seasoned for 60 days like other assets. However, any money contributed by family members has to be fully documented, and it has to be like an immediate family member. Savings for homeownership can be a challenge. And, one of the things I share with clients and I meet with them, because maybe some clients aren't ready to necessarily buy right now, but the tool that I give them is a really simple savings plan. And I want to share that with our audience now before we go into our assistance programs. And that's just this approach of trying to kind of calculate savings for yourself. And so here's kind of the approach I would take for someone that's trying to build their savings account up. So one of the things we talk about in our home buying discussions is our monthly budget that we feel comfortable with versus what we're paying in rent. So let me give you an example, and let's do the math. We'll make it really easy. So if I'm paying $2,000 a month in rent, but I feel like I can afford a $4,000 mortgage, but I'm not quite there from a savings perspective, what I encourage clients to do is start paying yourself in your savings account like you're making a mortgage payment right now. So here's what I mean by that is set aside $2,000, which is the difference between your prospective mortgage and your rent payment, and just without fail, put that into your savings account on a monthly basis. So it's $2,000 that goes into that savings account. It's you now start developing the habit of paying a $4,000 mortgage payment, but at the same time, you're growing your savings account, right? And then, after 6 months, we're at $12,000. After a year, we're at $24,000. And next thing you know, we've accomplished, the goal of saving for at least our down payment or closing costs. So I would encourage you to take a similar approach in building savings, because it tends to be one of the biggest challenges for home ownership. There's kind of two big challenges. It's savings, but it's also credit, which we reviewed earlier. But hopefully that savings plan approach can help you be on that path to home ownership a little bit sooner. Now, there's other resources like assistance programs that we're going to talk about now that can also help you along that path towards home ownership. I mentioned earlier about CalHFA, which is the California Housing Finance Agency. That agency we partner with to help support low to moderate income households. You may have heard recently about CalHFA because it's getting a lot of spotlight right now for a program that we're right in the middle of right now. It's called the Dream for All program. Some of you may have heard about that. It was on a lot of the news outlets, like KTLA did a spotlight on it. If you're in Sacramento, I think some of the CBS up here, ABC did some stories on that. Dream for All, basically with CalHFA, is an opportunity to get 20% of your sales price in assistance or $150,000. In exchange for that, CalHFA has a shared equity appreciation agreement with you, the buyer, right? And it is a lottery-based program. We're right in the last 4 or 5 days of the registration period for the lottery. The lottery for that program closes on April 29th, which is Monday at 5 p.m. I have a separate video on Dream for All that's available on our YouTube channel. We won't have a lot of time to dive into Dream for All tonight, but I would encourage you to check that out. If it's something you're interested in, you would have to act now because we're at a very limited time, but hopefully there'll be a phase 3.0 available next year. Those funds on Dream for All are kind of based upon state general funds, whereas the two products that I want to share with you now are always available through CalHFA. The first one is the MyHome Assistance Program that provides up to 3% of your sales price in assistance for a conventional loan, 3.5% for an FHA loan. And what it ultimately does is it's satisfying the minimum down payment to qualify as a first-time buyer. And the state is providing you with a low interest rate, simple loan of 1% on that assistance funds. And then generally the first mortgage rates tend to be about 0.25% below market rate. Now, for some of our buyers that need more help, there's also the ZIP assistance funds that are available. But unfortunately, with the ZIP assistance in today's market, that program really tends to push the interest rate on the first mortgage up by a full 1%. As this market changes a little bit, the ZIP assistance program might be a little bit more appealing, but ultimately it provides 2% of your loan amount or 3% as a zero interest rate option. It can be added on to financing in addition to the MyHome Assistance. Question in the chat, I want to just touch on really quick before we talk about the income limits for some of these first-time buyer programs. Question is, how much money should we save in total for a home costing around $700,000, including down payment and closing costs? I'm going to answer that question, actually show you guys an example of that in just a second on the next slide. And we'll give you a sense of what that looks like, because closing costs can generally be 2 to 3% of your purchase price. And then of course the minimum down payment is about $21,000. On the CalHFA product, here are the the maximum income limits for the program. So on the far right is the Dream for All maximum income limits by county in the Southern California markets. And on the left-hand side is the 3% MyHome Assistance or 3.5% MyHome Assistance. These income limits are based upon the applicant income, not the household income. And that's really important to understand because especially with Dream for All, a lot of clients will apply and not realize that they can apply by themselves. So for example, if I was buying a house by myself in LA County and I made 120,000, but my spouse made 100,000, I could technically apply in just my name and be eligible for LA County with my financing. Okay. So the question about the expected amount out of pocket, good thing is we have a scenario exactly for 700,000. So if you were to buy traditionally without assistance programs, your down payment's going to be 3%, which is 21,000. We would also want to save money for closing costs, which I always budget about 2 to 3% of my purchase price. So if I was not using an assistance program, I probably need about $35,000 to $42,000, right? So that's a bit of a stretch for most of our first-time buyers. Most of our first-time buyers maybe have $10,000 to $15,000. So when we kind of factor in that MyHome Assistance of 21,000, now that number total cash out of pocket maybe drops down to, maybe $14,000 to $21,000, which becomes a lot more attainable, especially as more of a near-term goal for home ownership. And that's really where that MyHome and or the ZIP assistance can help complement buyers in that pursuit of home ownership. Here's some of the eligibility requirements for CalHFA. The minimum credit score for the FHA version of CalHFA is 640, conventional is 680. We talked about debt to income ratio just a second ago. You can go 45 to 50% debt to income ratio on these products. We talked a little bit about the income qualifying. It's going to be based upon the applicant, not the household income. And it's designed for first-time buyers. So a first-time buyer is someone that has not owned in the last 3 years as their primary residence. Just as a quick kind of footnote on Dream for All, there is a different qualifier on Dream for All that I did not mention. It's called a first generational requirement. And what that means is a first generation buyer is someone that has not owned in the last 7 years and their parents are not currently homeowners in the US. So across the entire country. So that's a different wrinkle in the Dream for All program. So it's not only being a first time buyer, but also a first generational buyer. Now, these first-time buyer programs are available for all one-unit properties, single-family homes, new construction homes, condos, townhouses, some below-market homes that are available in communities. Manufactured homes can potentially be eligible, but they have to be on land that is owned. It can't be like in a mobile home park or anything like that. All right. Okay, any other questions before we talk about kind of the buying process? All right. All right, so we're just about 10 minutes from the top of the hour, so I promise to get you guys out of class on time. Let's go walk through the kind of the workflow of buying a home. And so after leaving tonight's class, you're maybe interested about putting together a home buying plan. I'm going to give you some of kind of the next steps and what that looks like after we talk about workflow. But a consultation is what we do with clients. It's about a 30-minute session. And the output of that session is to issue what we call as a pre-approval. And a pre-approval allows you to start going out and looking at homes. The pre-approval is generally good for 60 days, but it can always be recertified. So because a lot of our clients aren't looking to get pre-approved on a Wednesday and go buy a house on the weekend, right? It doesn't happen that way. It usually takes about 3 to 6 months as their cycle goes to be able to purchase a home, because that house hunting phase is generally kind of the longest phase. I have some clients that have been shopping for homes for 3+ years, right? It's not as easy as you might think. But I would encourage you, when you decide to take that step into house hunting, connect with a realtor in your local market. We do have preferred realtors we work with that we can always introduce you to, but a realtor is going to be an expert in their market and help support you in negotiations and finding the right home that works for you and your needs in home ownership. A pre-approval letter can also be updated to match whatever your offer price is. So even if you get pre-approved for 600,000 and you find a house for 550, we may want to adjust that pre-approval to match your offer price. I see some questions in the chat. I'm going to get through the workflow and then I'll come back and answer these questions. So we'll definitely get those answered for the group. Let's kind of continue on the process. So let's say I'm out looking for homes. I find a house I love. I make an offer. The seller says, yes, I'll accept your offer. Now we've started what we call as the escrow process. The escrow time period of that process is generally 30 days. So from the time the offer gets accepted to the time I get my keys, it's usually 30 days as a baseline number. Now, I was speaking with a client today and her offer period is like 45 days, right? So it could be as long as that. Sometimes it's short as 14 days. It really just depends on each transaction. Now, as a buyer, if you get that accepted offer, you have some action items on your side, which includes, dropping in an earnest money deposit, which will be within 2 to 3 days of your contract. That is usually 1 to 2% of your sales price. Those funds go towards your total out-of-pocket expense. We'll also start initiating the appraisal ordering of your transaction. Your realtor will help order inspections. And within 72 hours of your accepted offer, you receive disclosures on your financing. But we also reach out to you right after your accepted offer and say congratulations and explain to you all of these next steps, but also schedule you for a follow-up consultation, which is a 30-minute one-on-one with me to make sure your financing is all designed properly. Here's kind of what an earnest money deposit looks like. It's, like I said, it's 1 to 2% of your purchase price. Those funds go towards your total out-of-pocket expense. Now, in starting a real estate contract, especially in California, there's what we call is contingency periods, which allow you to do your homework on the property. So you're going to want to make sure the house appraises for what you're buying the home for. You want to make sure your inspections, check out okay, right? We want to make sure there's no dry rot or the roof falling off or foundational issues. All those things are important to investigate. And finally, want to make sure that your loan gets approved. So those inspections, the loan approval, the appraisal, that all takes place in the first 14 to 17 days of your contract. Now, as we move along in the workflow, step 3 is the administrative task, like the processing of your loan, which will include verifying your employment, making sure all the documentation is tightened up correctly so the underwriter can review everything. We probably have your interest rate locked in by that time. And now, at that point, now the loan gets submitted to an underwriting team that physically underwrites the loan from a risk perspective. They'll then issue that approval within a couple days. And if everything checks out, then you're going to be able to remove your loan contingency. If your appraisal is good, then you remove your appraisal contingency. And of course, your inspections will want to be right. So it's important that you're going to have that protection for you as a buyer. But once all those items have been completed, like your inspection, appraisal, and your loan approval, then you can remove that contingency. But it's important to understand also, though, at the same time, when you remove that contingency, that also is telling the seller that you're good to go, you're ready to move to the final stages of the process. Now, at step 5, we also issue to you a final closing disclosure, which basically gives you a 3-day cooling off period to make sure everything matches up on your financing, all the numbers align to what we've talked about during your follow-up consultation with you to make sure everything is, just exactly what we expected. During that follow-up consultation, we're talking about timelines, your expected out-of-pocket, your interest rate, your product. You're going to have a really clear idea within 2 to 3 days of your accepted offer, all of your financing. So we just want to make sure that everything matches up as we move through the process. And then finally, at step 6, that's where we sign final documents in person with a public notary. Everything up to step 6 can all be done electronically, but we're still a little old school at step 6 where we have to sign documents in person. At that point of signing documents, you'll then also be wiring in your final funds for the home purchase. That money will get reconciled by an escrow team, and then our team here at American Pacific Mortgage will then wire in the funds of your financing. That money gets all balanced out, and then items get recorded or documents get recorded with your county recorder's office. They record what we call as a grant deed that transfers ownership to you, as well as a deed of trust, which is your agreement to repay the loan. And so the escrow team will get confirmations of those documents recording. And then guess what? After that all happens, you become the official owner of the home. So that's when we get a chance to make that call to you and say, hey, congratulations, you're now a homeowner. I got a chance to make a few of those calls today. It's best part of my day next to teaching a class, of course, like this. But, it's a celebration, right? So it's a big journey. We understand it's not with some, anxiety and some, feeling of pressure and just a lot going on, a lot of moving parts. But, we're here to help support you to create the best buyer experience possible, because this is going to be one of the biggest purchases you guys decide to make when you go on that path towards home ownership. Now, if you're thinking about moving forward and maybe doing a consultation with us, we'd love to be able to connect with you for a one-on-one, or maybe even have some questions after tonight's class. Here's kind of how our next steps would look. So if you do have questions after tonight's class and they don't get answered on air, we can get connected with an introductory call for you. It's a 15-minute quick call to make sure you get all the goals, we understand your goals, or answer a scenario for you. The consultation is that 30-minute session with me on video to design a home buying plan for you, a comprehensive plan to help you understand your resources, your products that are available to you. Just map out a plan. So whether you're going to buy next month, next year, or 2 years from now, you at least have kind of some goals and objectives for home ownership. So that's kind of what the next steps would look like for you. Here's kind of what the framework is in the consultations, very similar to what we've talked about in tonight's class. We look at, where do I want to buy, my budget, maybe my credit opportunities, assistance programs that I can take advantage of. Just do a full kind of analysis of everything. And then out of that, hopefully be able to issue you your pre-approval for home buying. Okay. All right, let me get to some of these questions in the chat. We're going to be kind of wrapping up. We're almost at the top of the hour. One question was, what's the best place to put money in while you're saving for down payment? I think, there's some great high yield money market accounts out there right now. I think, paying 4% still plus, there might be even higher rate of returns out there. So I would probably put something in a high yield money market if it was my money. Do you have to repay any of these down payment assistance programs? So the answer is yes. On the first time buyer programs, they generally don't require repayment until you either sell the home or if you refinance in the future. And another question was, do you need to take a HUD course to certify for first time home buyer programs? So it's not necessarily a HUD class. The state of California, or CalHFA, has designated classes, usually through e-housing. Those classes are all available on our website. Specific to Dream for All, there's a 1-hour shared appreciation class. For all the other first-time buyer programs, there's an 8-hour online class. We recommend not taking the 8-hour class until you actually have an accepted offer with a seller, because the 8-hour class actually has a $99 fee. I mentioned to you about our mobile tool. This is a great tool that a lot of clients will start their application with, or use the calculator function. It's also going to push notifications for you on what's going on with your financing, especially if you're in kind of the process. It's all available for Android and Apple, so we'd encourage you to check that out. I mentioned earlier a little bit about our wonderful partnership with Long Beach State Alumni and Athletics. I couldn't be more proud to help, kind of be a part of that. And, because of that partnership, we provide a discount to you as being part of the Long Beach State Alumni and Athletics. We also do have other partnerships across the country. So like I said earlier, if you have friends or family or coworkers that would benefit from a class like this, have them come check out one of those classes, and maybe they might be affiliated with some of those other partnerships. This is all my contact information. So if you do have follow-up questions from tonight's class, don't hesitate to reach out to me. I'd love to be able to help get connected with you and provide you any support that you need. And we'd encourage you to follow us on some of our social channels. I mean, we put a lot of good content on our Instagram. On YouTube, you're not only going to have this class there, but also things like the Dream for All video class that we've done. All of our past homebuyer classes try to put a lot of good information that's going to help support you on this journey. And we love what our communities across the country say about us, because I think that's really important reflection of what we're doing. We're not just educating you, but we're also helping create a buyer experience. So we'd encourage you to check out some of our testimonials on some of our reviews on not only Google and also on Yelp. Okay, so that takes us to the end of class. I got to the top of the hour. But I do have some questions, and I'm going to stick around for questions tonight because I want to make sure I get you guys all the information that you need to help you on this journey. So the first question is, if you've changed, I think this is an employment question, which is if you've changed industries within the last 2 years, but have been working the whole time, is it still okay for the 2-year history? So answer is yes. So you don't have to necessarily be in the same industry. It may get a little tricky if you're Mike more on a variable pay basis, like you get commissions or bonuses. If it's a completely different industry, that might change things a little bit. For the most part, when you have variable compensation like bonuses or RSUs or commissions, we do have to see in that case that you've been on your job for 2 years. But if you're on a salary or a guaranteed hourly, then there's no like time frame necessary. All right, great question. I'm glad you asked that because that allowed me to kind of bring up the other variable compensation question too. All right, what other questions do we have from our audience? I know I'm probably right before dinner, so I totally get it. All right, anything else? All right, I think we're good. Well, if you didn't get your question asked tonight and you do want to get connected with me, don't hesitate to reach out. It was my pleasure to get a chance to present this content to you. I do hope I get a chance to connect with each of you and help design your own home buying plan, and we can help support you on this journey towards home ownership. Have a wonderful night, and we'll look forward to connecting with you soon. Good night. If you're still there, answer this question. If you're still online, the question of 20 to 25% down payment, really not a benefit of using FHA. If you're putting that much down, we would definitely want to look at a conventional loan option. All right, hopefully you got that answer. Good night, guys.